Hey folks, you don't want to miss a second of today's episode because I'm going to talk about why Warren Buffett is sitting on hundreds of billions of dollars in cash and why that is. And I want you to stay tuned to the end because that's when I'm going to tell you what it means to your investments. So stick with me today. We're in for a ride. Mark Miller here with Hilton Wealth. Warren Buffett is not really known to be one that generally panics. He's known for his patience, his discipline, and buying when the price really generally makes sense. So when Berkshire Hathaway holds, say, the largest liquidity position really in corporate history, people are naturally asking, what does Buffett see that we don't? And that makes sense. But the better question is not, is Buffett predicting a crash? Because you may think that's what it's about. The better question is, why is Warren Buffett refusing to chase where there's really no good markets right now and no excellent investments to really go after? So we believe the smart money does not simply react to headlines. It prepares before the headlines even arrive. So Buffett's cash pile may not automatically be a warning sign, but it may just be a masterclass in discipline. So Warren Buffett does certain things that people question, and they're wondering, is he a little bit too conservative? By the way, anything I talk about today is not investment advice. You need to do your own research and spend time with a competent advisor. So what is actually happening at Berkshire Hathaway? So Berkshire, I don't think, is really out of the market. They just have right now enormous liquidity. Berkshire still owns operating companies, insurance businesses. They own BNSF Railroad, which is a multi-billion-dollar railroad company, utilities, energy assets, public stocks. The cash position is largely, though, in short-term Treasury bills, but it amounts to almost $500 billion right now. And Berkshire obviously earns income on this money that's there, and I'll talk about that in a few minutes and why that's important. But in the first quarter of 2026 alone, Berkshire purchased about $16 billion in equity securities, but at the same time, they sold about $24 billion, making generally a net seller for that quarter. So Kiplinger reported that Berkshire has been a net seller of stocks actually for the last 14 quarters. So you got to kind of wonder, well, what does that mean? Well, I'm going to talk about it's about waiting for opportunity, but why is Berkshire looking at things and not seeing the opportunity that maybe others might be seeing? So I think it has to do with the fact it's not necessarily, hey, they're liquid because they've got to be out of the market and they're afraid of a crash. It's a plan that they've had for many, many years to position themselves to be more in cash because there's not a lot of good discounts out there right now. So they're just not deploying as much money. So this is kind of similar, though, how a lot of sophisticated families think. They're not just looking at one investment account. They're not looking at that in isolation. They look at the whole financial picture: income, taxes, risk, liquidity, insurances, business interests, estate planning, and ultimately legacy. Berkshire's not sitting out. Berkshire is kind of, you might say, waiting for a better pitch. By the way, Warren Buffett is a big baseball guy, so I'll use that analogy. He's not necessarily just sitting there swinging at everything because he doesn't want to strike out. He's kind of watching balls and watching strikes, but he's not seeing a lot of good strikes that come across the plate. So let's talk a little bit about these parallels between now and 1999. This is not the first time Buffett has maybe looked wrong, like he doesn't know what he's doing. So he's been criticized in the past, and he was back in 1999 when the market was exploding, when things were really hot. Now, that might give us some clues right now, but I don't want you to draw to too many conclusions, come to too many conclusions quite yet. In the late 90s, technology and internet stocks were absolutely exploding. Buffett largely avoided the dot-com internet stocks because he couldn't confidently forecast their long-term economics. At the time, many critics said Buffett kind of had lost his mind and he lost touch. He was missing out on this internet boom. Well, between the summer of 1998 and early 2000, Berkshire shares fell 44%, while the broader market rose 32%. And Barron's famously ran a "What's Wrong with Warren" headline. You may remember that if you're old enough. That was a big deal. People were saying he's done, he's lost his touch, he'll never be a good investor again. Within months, the dot-com bubble famously began to unwind. Buffett's discipline eventually looked very different in hindsight, obviously. So this is one of the hardest parts really of wealth planning in general. Discipline can feel wrong before it proves that it's actually right. So the smart money is often criticized during kind of the party times because it refuses to dance to every single song. So Buffett was not wrong because he missed the party. He was early in recognizing that the party was getting expensive, which I'm going to talk about is not far from where we are today. So what is Buffett's 1999 warning to us? So returns have to be and need to be tied to reality. Buffett's 1999 warning was not about hating technology. Technology is bad. It was really about valuation, that things were so expensive, he couldn't find the value in things, so he had to sit in cash for a long time until he could. Sound like anything familiar right now? So at Sun Valley in 1999, Warren Buffett warned that investors were expecting too much from stocks. His argument was simple. Over long periods, investment returns have to be connected to earnings, interest rates, business profits, the price investors are truly willing to pay, and you hope that as a good investor, you're getting things at a discount, right? He argued that future stock returns were unlikely to match the extraordinary returns of the past 17 years. So in a 1999 Fortune magazine piece, Buffett said his most probable estimate for aggregate equity returns, assuming constant interest rates, 2% inflation and fractional cost, was maybe about 4 to 6%. He was also warning investors that transformative industries do not automatically create great investment returns. And actually, that's pretty darn good advice. So this is the exact lesson our families need to hear today. A great story is not the same thing as a great investment. A great company can still be a poor investment if the price is wrong. Price still matters even when the story is exciting. So let's compare 1999 to today. Similar discipline, maybe different technology view. The similarity is valuation discipline. The difference is that Buffett is no longer completely avoiding technology. So let's talk about this a little bit. Back in 1999, the market mood was everybody was buying internet stocks because the internet was the hot thing and everybody was pouring in. In the current environment, AI and kind of these mega cap tech stocks are driving the market enthusiasm and making the market continue to run. In 1999, Buffett's stance was He avoided most of the internet and telecom names. Now he's more selective with technology exposure and plays. So again, he's not completely out of the markets, but the majority of his money is in cash right now. So here's some criticism. In 1999, they called him too conservative and out of touch, and that he was losing it. He was getting too old. By the way, he's really old now, but back then he was, quote, too old. And in the current environment, they're questioning him for holding so much cash while this tech rallies. So what are the core concerns? Well, back then in 1999, weak or uncertain cash flows and extreme valuations. In today's current environment, high valuations plus huge AI capital output with no shorter term returns. And I'll talk about that in detail in a few more minutes. So what is the purpose of all the cash? Well, back then in 1999, it was kind of him waiting for better prices to become available. And in today's environment, well, he is earning, probably 4 to 5% on his cash. Several years ago, you couldn't get that at all, so you had to take more risk. So he's getting income from that cash position, and he's kind of preserving in the investment industry, we call it dry powder. So we're ready to at any given time to deploy assets if we need to. So what's the Hilton lesson here? Well, first of all, we don't chase the hype, and great investors don't chase the hype. And today it's like the bottom line is you have to build a better plan that we can wait out times like this, because what I've talked to a lot of my clients about is many clients that come to us for the first time, they've made a lot of money in the markets over a lot of years, and they're kind of in this place where their equity position gets way overweighted, and they kind of just think it's going to continue to go on. In reality, we know that it's going to shift at some point, and I think Warren Buffett knows this too. If you want to read the tea leaves, and they don't want to be stuck where they're, say, 70 or 80% in equities. In 1999, Buffett's circle kind of kept him away from a lot of the technology stocks. Today, Berkshire has owned major technology-related business like Apple. He's recently divested from Apple a little bit more, but more meaningful position in Alphabet. So this is not Buffett abandoning his discipline. It's Buffett adapting his circle of competence. I think he understands, and I think Berkshire in general understands, obviously, the power of technology. Back then, I don't think he was embracing it as much. So the distinction is important. He's not buying technology, though, just to buy technology because it's the cool thing to do. He's looking for durable economics, cash flow, customer loyalty, and companies that really truly have a competitive advantage. So in 1999, Buffett avoided technology completely. Today, he appears to be separating speculative technology from technology with more durable economic moats, you might say. So, by the way, if you got value from what you're hearing today so far, please like, share, and subscribe to the podcast. We'd really appreciate it. So what's the big shift from now? Why Apple, Alphabet, selective adaptation on his part? So his technology view has evolved from complete avoidance to selectivity, and for a good reason, like I mentioned. So in 1999, Buffett avoided internet stocks because he couldn't predict which companies would still matter, or a decade later, it was really difficult at that time to do that. Today, Berkshire has been willing to own major technology platforms when the business behaves more like a consumer infrastructure, when they are certain that the company is going to be around, say, 20 years from now. So Berkshire's Apple position became extremely large. Kiplinger noted Apple is now down more than 40% in Berkshire's stock portfolio. When it was at its peak, it was more than a fifth of the portfolio. Berkshire also more than tripled its Alphabet Class A and Class C positions. And Business Insider later reported that Berkshire's Alphabet wager had reached nearly $31 billion after an additional private placement investment, assuming there's no further changes, but that's kind of updated as of now. So I would present that $31 billion in Alphabet, that figure is probably a reported estimate. It's not on the official, quarter one filings or anything like that. But the key here is this is how wealthy folks should think as well. The goal is not to be kind of anti-growth, anti-technology, anti-market, anti-equity. The goal is to be selective. Own what you understand the economics, understand the risk, and never confuse excitement or emotion with good strategy. So Buffett didn't abandon his rules. He's just expanded that circle kind of cautiously. So why the AI changes, and how does AI change the economics of kind of big tech in general? So the AI boom maybe, and I'm not even going to say maybe, is real, but it's also very expensive. So the current AI environment is really different from the old software model. Many software and internet platforms used to be viewed as, kind of capital light, kind of compounders. AI infrastructure requires enormous spending on chips, data centers, power, cooling networks, compute capacity. Alphabet recently raised its full-year capital expenditure guidance to almost $200 billion in 2026 alone, and is expected to spend more than $700 billion in the next few years. So that is a lot of money just for one company to invest in infrastructure. So that doesn't mean that AI is fake by any means. It means investors have to ask the hard question. What is the return, and what is the return going to be on all of this massive spending? So at Hilton, this is where we separate the headline really from the wealth plan. AI may change the world, but investors still have to ask the question, what is the cost? What is the cash flow? What is the risk? And what price am I willing to pay for it? So we can learn from Warren Buffett in a certain extent. So a revolutionary technology does not automatically mean that every investor earns a revolutionary return. It has to be tackled, and it has to be attacked in the proper way. So let me give you some reasons individual reasons why Warren Buffett is in so much cash. Well, first of all, cash finally pays a little bit. So it wasn't that long ago that cash had almost 0%, maybe 1% that it was paying. Well, cash is more attractive today because short-term Treasury bills can produce meaningful income. For many years, again, cash didn't earn anything. That made investors feel pressure to take more risk and just earn any kind of return. Today, Berkshire can hold short-term Treasury bills, earn income, remain liquid, to give Berkshire the ability to wait without feeling forced into an overpriced asset, because they're making 4 to 5% on that, $500 billion. That's billions of dollars in yield. Okay. So one of the biggest mistakes that investors make is thinking every dollar has to be aggressively invested at all times, or else you're not investing. The smart money understands that liquidity, it has a purpose and it has a place. Cash may not be exciting, but when used properly, it can provide stability, flexibility, and real opportunity to invest for the future. So cash is no longer dead money. So patience is being paid for now. So cash is actually earning pretty good money right now. So reason number 2, so Berkshire has insurance responsibilities. So you may or may not know this, but insurance is a big core base of Berkshire Hathaway. And the reason is because insurance pays really, really well, especially companies that deal in like life insurance, some property casualty companies. A lot of the times they're sitting on a lot of cash. So they're quietly the economically most powerful companies in the world. We think immediately it's banks. Probably insurance companies are a little wealthier, believe it or not, than banks are. So, but Berkshire's really kind of just a major insurance business. Insurance companies collect premiums today, and may have to pay claims later, but those insurance premiums are just continual cash flow. And that's why Berkshire Hathaway's invested in a lot of insurance company. That creates what's called insurance float, which can be powerful, but it also requires a lot of discipline, though, too. Berkshire must be ready for claims, catastrophes, unexpected stress. Cash protects Berkshire from being forced to sell assets during market weaknesses also, okay? Now, again, you could read the tea leaves. Yes, waiting for opportunity, but I think there's a little bit of defensiveness in this too. And that maybe Berkshire's and Warren Buffett's telling us a little bit that we've had this massive run up for so long. Now maybe it's time to be a little more defensive. And they're protecting themselves, and they need to for their insurance responsibilities to be met too. So this is exactly how families, we believe, should think about liquidity. A portfolio should not only be built for sunny days and great returns. It should be built for taxes, income needs, healthcare costs that come up, business transitions, family obligations, emergencies, market volatility, all of these things. So cash is not just money sitting there waiting to be invested all the time. It is also protection against being forced to make bad decisions. So let's talk too about, I mentioned the term earlier called dry powder, which is kind of a term in the investment industry for having cash and money there when great opportunities come along. So cash gives Berkshire power when others are under pressure. Dry powder means available capital. When markets are stressed, many investors need liquidity, so they can use that liquidity when things aren't going well. Berkshire can step in when others are forced to sell. It doesn't need to borrow heavily. It doesn't need to sell goods, assets at bad prices. It can act quickly when the right opportunity appears, and I can guarantee you Berkshire will take advantage of that when it does. When things get discounted, when the markets move, when things change, valuations get under control, there'll be big buyers of a lot of things. So this is one of the biggest differences, really, I think, between reactive investing and family office style planning. The goal is not to just survive volatility. The goal is to be positioned in those times of great volatility to then be able to take advantage and do well in those particular times. So cash gives Berkshire the ability to be aggressive when others are forced to really be defensive. All right, so let's talk about what's important here. What do we want to do and what do we want to copy out from what Warren Buffett is doing? So Buffett's cash position does not mean that every investor should sell everything, jump into cash right now. It really shows he has a plan, just like in 1999. And all of us need to have a plan. We don't want to have knee-jerk reactions. Berkshire's not a normal household portfolio. I realize that. But Berkshire has permanent capital, operating businesses, insurance float, and different tax pictures than obviously individual families do. But individual investors generally do. They have different needs. They may need retirement income, tax planning, estate planning, all these things we've kind of talked about before. So copying Berkshire's exact allocation without understanding these things is not the purpose behind this. So, but you do want to copy the headline. And what is the headline? That you want to understand the principle. Buffett's cash positions is not a one-size-fits-all. It's a reminder to be intentional and think things through and have a plan, have a strategy. So Buffett's cash position, it's really a lesson in discipline, not a command for every investor to jump into cash right away. And by the way, if you're concerned about some of the things we talk about, we can do a risk and wealth assessment for you at Hilton Tax and Wealth Advisors, and we can kind of show you some of these things, be very unbiased about it, and kind of show you the position you're in. Maybe you're caught in a position where you have too much risk exposure. That could be the case, and we'll show you that. But you don't want to just do a knee-jerk reaction and just pull everything and throw it into cash. You really have to have a plan. And if you weren't planning to get into cash like several years ago when he was, then you need to figure something else out. So investors should copy Buffett's principles, okay? And don't follow his portfolio exactly. And first, check your plan. Is it taking into account what's most important? And do you have too much in, say, overvalued assets right now that don't look very good on paper? So here's the principles to highlight. So don't chase performance. Don't confuse, under any circumstance, momentum with any kind of value. And know what you own. You should understand and know what you own and understand the price that you're paying. And it's like anything. Everybody wants to get a wholesale price on anything. So it's no difference in investing. We want to get a wholesale price in investing too. Understand the true risk and keep enough liquidity at times so you're ready and have that dry powder when you need it. Avoid forced selling under all circumstances. And also you kind of need to be tax aware of what happens when you do sell things to go into cash. And when you do build income, you really need to have an income plan and build it intentionally, protect against your volatility, and be ready when the opportunity improves. And then the big thing that I talk about a lot in other podcasts I've said is the wealthy tend to look longer term. So think in decades, not in headlines. So this is why we talk so much about the Hilton True Wealth portfolios and True Wealth planning. It is not just about your individual investments. Are you in every single right investment? It's about coordinating the full financial picture so families can be confident that the decisions that happen are the right decisions really in uncertain times. So the real lesson is not hold cash under all circumstances. The real lesson is build a plan that can last for a long time and be patient in the waiting for when the proper time is to buy and when the proper time is to sell. So if you want, by the way, if you want to learn more about these concepts, go to hiltonwealth.com and we'll send you a complimentary copy of Hilton Wealth, How to Invest Like an American Dynasty. That's a book that Brad Hilton and I wrote together, and it has some really, really good education points in there to learn more. So finally, in closing, when Warren Buffett has put a lot of money in cash in that position, it's not necessarily a prediction of where the market is going tomorrow and a crash. It's a reminder that discipline matters a lot. Very similar. Honestly, we are. And if you'd like to reach out to us, I'll talk to you about how this is very similar to 1999 when Buffett was criticized for refusing to chase this dot-com bubble. The difference today is that Buffett's not ignoring technology entirely, but he is selective and he's still sitting on a lot of cash. But it's because there's not a lot out there to buy that's at a discount, bottom line. So for the everyday investor, The takeaway is not to copy Berkshire's exact cash position. The takeaway is to think like the smart money thinks. Know why you own what you own, understand your risk, keep enough liquidity, avoid this chasing, make tax-aware decisions, and make sure your wealth plan is built for uncertainty and opportunity. So at Hilton Wealth, we believe the smart money prepares for the crash at all times, and of course, being prepared for when the opportunity appears. So that's how long-term wealth is built, protected, and passed on. That brings us to the end of today's episode of Hilton True Wealth. If you want to learn more about topics relating to building your wealth, tax planning, cutting-edge tech, and family office services, we're here to help. Be sure to follow us wherever you get your podcasts so you'll never miss an episode, and give us a like or a review. And if you're curious to learn more about your wealth, tune in every Tuesday for new insights and special guests. If you found value in what you heard today, share it with someone who might benefit too. For more insights, resources, and to get a free copy of our book, Hilton Wealth, How to Invest Like an American Dynasty, visit us at hiltonwealth.com. Thanks for joining us. Until next time, keep learning, keep growing, and keep building your true wealth.